If you're dreaming of building your own home from the ground up, you're likely exploring the exciting possibilities that come with creating a space perfectly tailored to your needs and desires. But before you even break ground, understanding the financial side of things, specifically construction loans, is absolutely essential. Whether you're envisioning yourself as the hands-on owner-builder or planning to hire a professional to manage the construction, this video will break down what you need to know about financing your new build in 2025. So let's dive in. So you're ready to build your dream home, but what exactly is a construction loan? In essence, construction loans are short-term loans specifically designed to finance the building of a residential home. Now, unlike traditional mortgages used to purchase an existing property, a construction loan provides funds to cover the various stages and costs involved with building from the ground up. It's important to understand right from the start that construction loans typically have tougher qualification criteria and often come with higher interest rates compared to conventional mortgages for existing homes. This is due to the increased risks that lenders take on associated with financing a project that has yet to be completed. Now, what exactly can you use a construction loan to pay for? Generally, these loans are intended to cover the direct costs associated with building your home. This can include things like the land or lot itself, contractor labor cost, the cost of building materials, and even necessary permits and fees. So while construction loans cover the physical building costs, it is important to note that they don't typically include the upfront design expenses. So having finalized house plans is generally going to be a prerequisite for even obtaining a construction loan. Lenders need to know exactly what they are financing. Now that we know a little bit about what construction loans are, let's delve into how they actually work. The process has some key differences compared to getting a standard mortgage. One of the first things to understand is the initial term of a construction loan. It's generally quite short, often a year or less. During this time, the expectation is that the entire construction of the project will be completed. Because of this tight time frame and the loan's dependence on obviously the progress of the build, lenders are going to require significant upfront information about your build. You or your general contractor, if you're hiring one, will need to provide the lender with detailed construction timeline, a comprehensive building plan, as well as a detailed and realistic budget. A crucial aspect of how construction loans work is the distribution of funds. Unlike a traditional mortgage or a home equity loan, where you receive a lump sum, a construction loan disperses money in stages known as draws as your new home progresses. These draws typically coincide with the completion of major construction milestones, for example, after the foundation is laid or when the framing of the house begins. Think of it this way. When buying an existing home with a traditional mortgage, at closing, the bank goes, "Here's the money to cover the purchase and buy the house from the seller. Please pay us X amount monthly." Sure, they aren't handing you a bag of cash directly, but they are loaning all of the money to you upfront in one lump sum for your purchase. On the flip side, when taking out a construction loan, at closing, the bank goes, "Here is a stack of papers to sign. We have this money available for you, so get to work on that dream home that we discussed. And when we see some progress, then you can access this and pay for the work being done." With a standard mortgage like our first example, you usually start paying monthly principal and interest payments immediately. However, with most construction loans, your lender will expect you to make interest-only payments on the funds that have actually been drawn to date during the construction period. You're only obligated to pay interest on the actual amount of money that the lender has released to you so far. So for example, let's say that you closed on your construction loan and the lender tells you to get to work, but it's springtime and you live in the South. If you know anything about living in the South in the springtime, with all of the rain and the storms, doing your site prep and foundation work could likely get delayed. If you don't start construction, let's say, for 3 months after you close on your construction loan, then you won't have progress to show for your draw money. Since you haven't drawn any money from your construction loan, you aren't paying anything to the lender because the interest payment is only on the amount of money that you have drawn, not the entire amount of money made available to you. Now, I do want to mention that once you start drawing funds on your construction loan, you will have monthly payments moving forward, whether you have drawn more money that month or not. For example, let's say that I've made great progress on my build and I'm about 50% of the way through construction. And at that stage, I have taken a few draws, let's say, to cover the spend. But now, Kachi decides to surprise me with a month-long vacation. Obviously, I'm packing my bags and I won't be able to work on my build. Even if I do not draw more money, additional funds from my construction loan while I'm on my month-long vacation, I will still be responsible for making my monthly interest payment on the funds that I have already drawn from the loan up until this point. Does that make sense? I'm trying to break this down and make it as easy as possible to understand. So if you have any more questions, let me know in the comments and I'll clear them up. To ensure that the project is on track and the funds are being used appropriately, lenders will typically involve an inspector who will check the house at various construction stages. As the work is approved, the lender will then release further payments or draws to the builder or to you, depending on your agreement. You can generally expect a minimum of 4 to 6 inspections throughout the entire build process to monitor the progress that you're making. Now that we have a good understanding of what construction loans are and how they generally work, let's explore the different types of construction loans that are available. These are designed to suit various different financial needs as well as building scenarios. One of the most common types of construction loans is a construction to permanent loan. As the name suggests, the big advantage here is the transition that it offers. Once your house is fully complete and you move in, this construction loan automatically converts into a traditional mortgage. Typically, you'll have options for your mortgage term, such as 15 to 30 years, and you can often choose between a fixed or adjustable interest rate. So a construction to permanent loan can take you from an interest-only construction loan into something like a conventional mortgage without the need for a second closing. Since this is all done upfront in one process before you even start construction, there aren't separate loan terms or documents that need to be signed later, meaning this is all done in one closing. During the initial construction phase of this loan, you're usually only responsible for making interest payments on the funds as they're drawn, like we talked about earlier. Once the loan converts into a permanent mortgage, then you'll be making regular payments that cover both your principal and your interest, just like with any standard mortgage. A significant benefit to this type of loan is that you typically only have to pay for one set of closing costs, which can save you a considerable amount of money, and you don't have to worry about requalifying for a loan later on. The second main type is a construction-only loan. This type of loan provides you with the necessary funds to build your home, but it's a short-term loan that you're responsible in repaying in full at its maturity, which is often within a year or maybe a year and a half. To repay it, you'll generally need to either have the cash available or you'll need to obtain a separate mortgage after construction is finished to pay off the construction loan. This is the type of loan that Kachi and I use most frequently. While the potential advantage of a construction-only loan might be the possibility of securing better terms on your subsequent mortgage later on, it can ultimately be more costly than a construction to permanent loan. This is primarily because you are completing two separate loan transactions, meaning that you'll have to pay two sets of closing costs. You'll also need to invest the time and effort into shopping for and securing that second mortgage. Furthermore, the one thing that I want you to understand is that there is a risk that if your financial situation changes, let's say, God forbid, you lose your job while you're building, you might not be able to qualify for a suitable mortgage later on to keep the house that you just built. For us, the construction-only loan makes sense because we are usually taking out these loans in a business name with a strong plan up front as to how we navigate post-construction. Meaning, are we selling the house? Are we moving into it? Are we keeping it as a rental? Depending on the different strategies, we may have different exit plans. So typically, these construction-only loans make sense for us. Finally, the third option is an owner-builder loan. These are also called a self-build loan. These can either be construction to permanent loans or they can be construction only when the borrower taking out the loan also acts as their own home builder. So this is probably what most of you watching this video fall into. However, it's important to note that most lenders are going to have strict requirements for owner-builder loans due to the complexities of construction and the need to comply with local building codes. In fact, on my last video covering construction loans, you guys had more questions about how to convince lenders to finance your build without a builder than anything else. I want you to understand this. Lenders often prefer borrowers to be contractors by trade in order to qualify for this type of loan, or be able to display past contracting experience. For example, if you have GC'd a renovation on your own home where you managed the budget and you hired subcontractors, that is, for most lenders, likely going to be enough experience for you to be able to get a construction loan without a builder and manage your own project. Lenders aren't necessarily going to be looking for hands-on building experience per se, but having experience managing projects, a thorough understanding of the build process, and just confidence in your budget will greatly improve your approval likelihood. I told our lender that I was making this video, and he said that the biggest mistake you can make when pursuing an owner-builder loan is walking to a bank unprepared without knowledge of what you're doing. So in this case, confidence really is key. He mentioned that if you have your lot, house plans that will actually fit on your lot, and a detailed budget that looks legitimate and isn't just chicken scratch on a piece of paper, you will get a much better response. I know that budgeting is a huge obstacle, especially when you're pursuing a self-build and may not have the knowledge of what everything costs. That is a big reason as to why Kachi and I made our build budget generator available to you guys. Trying to figure out how much all the little details will cost, like framing labor, windows, insulation, and more, can be overwhelming for anyone, even us as repeat builders. Using the size and price per square foot of your build, the budget generator will estimate and itemize all of those costs for you and generate a similar budget for you that we provide to our lender in order to get financing. Obviously, it's a great starting place. This will help you look legit. Let's now talk about a crucial aspect of construction loans, interest rates. It's important to understand how these rates typically work and how they compare to traditional mortgages. So like a traditional mortgage, construction loans can have either a fixed rate or variable terms. If it's fixed, it's set at the time of closing and your payment will only change as you draw more money from your loan. With a variable rate, your interest rate can fluctuate over time, typically moving in line with prime rates. As a result, your monthly payment can also change, potentially increasing or decreasing based on the rate terms and adjustments. This is also something to factor into your budget planning. It's also important to be aware that construction loan interest rates are typically higher than those you'd find on a traditional mortgage. There are a couple of key reasons for this. Firstly, construction loans are often considered unsecure in their initial stages. With a standard mortgage, the existing home acts as collateral for the lender. If you were to default on payments, the lender has the option to foreclose on the property, and then they have that asset. However, during the construction phase, that completed asset doesn't exist yet, leading lenders to perceive these loans as carrying a greater risk. On average, you can generally expect interest rates for construction loans to be around 1 percentage point higher than the mortgage rates for a traditional mortgage. While this can vary depending on the lender, your creditworthiness, the specifics of your project, and even whether you're hiring a builder versus owner building can all impact your interest rate. So it's a good benchmark to keep in mind as you're exploring your financing options. So what does it take to actually qualify for a construction loan? Lenders have specific requirements that borrowers typically need to meet. Let's break down some of the key criteria you can expect. First and foremost, you'll need to demonstrate that you are financially stable. This is similar to applying for a traditional mortgage. Lenders will want to see a low debt to income ratio, showing that you don't have excessive debt compared to your income. You'll also need to provide sufficient income to comfortably repay the loan, including the interest payments during the construction phase and the principal and interest payments once you transition to a permanent mortgage. For example, if you make $40,000 a year, a lender isn't going to give you the money to build $1 million home. Because even if you can swing the interest-only payments on what you're drawing, you won't be able to qualify for $1 million mortgage post-construction on $40,000 of income. Credit-wise, just keep in mind that you'll likely need a credit score of at least 680 to be considered for a construction loan. But the higher your score, the better borrowing terms you'll get. As we discussed earlier, be prepared to make a significant down payment. Just like with most mortgages, lenders will require you to put money down when you apply for a construction loan. The exact amount of money can vary depending on the specific lender and the total amount that you're looking to borrow for construction. However, you can generally expect construction loans to require a down payment of anywhere from 15 to 35% of the total project cost. Before we move on, let's talk about using your land as collateral. It's not always the case, but by the time you're pursuing a construction loan, you most likely already own the land that you're going to build on. Let's say that you need $500,000 to build your dream home, and your lender requires a 20% down payment. That would be a down payment of $100,000. If your equity in your land is worth $100,000 or more, you can use your land as collateral for your down payment, meaning that you will not have to pay more money down to start the loan. This is huge. Let me give you a few examples just to make sure that you really follow me. Let's say I bought a several acre tract of land with gorgeous views for my dream home, and I paid $100,000 for it in cash. That would be enough to cover the 20% down. In another world, let's say my land cost $200,000, but I paid $100,000 for it in cash and financed the other half. Since I have at least $100,000 in equity on the land, that should be sufficient for the 20% down. Now, in another world, let's say that I got a steal of a deal on my land and I only had to pay $60,000 for it. But like I said, I got a deal. The bank determines that the market value of the land that I own is actually $120,000. Even though I only paid $60,000 to buy the land, the market value of my equity exceeds the 20% down payment, so that would work. Now, in another world, we're really doing some space travel today. Let's say I didn't buy the land, but rather I inherited it. The same can be true. If the market value of the land covers the down payment needed, then you can use the land as collateral for the loan and not have a separate down payment. That's cool, right? Anyway, back to the requirements. Lenders will want to see solid house plans and a detailed construction budget. These documents are critical as they will help the lender thoroughly understand the scope of your project, the estimated timeline for completion, and the overall financial viability. Finally, in the last few stages, you can expect an appraisal. Even though the home isn't built yet, whether you're pursuing a construction only or a construction to permanent loan, lenders want to be confident in the future value of the home and that it will justify the amount they are lending to you. The appraiser will assess the blueprints, the value of the land or the lot, and other relevant details to arrive at a projected value. For construction to permanent loans, this future appraised value will also serve as the basis for the collateral once the construction is completed and the loan converts into a mortgage. Once all of this is complete, you'll be able to close on your construction loan and get to work. Building your own home is an exciting and significant undertaking. By understanding the intricacies of construction loans and being prepared for the financial requirements, you'll be well equipped to turn your dream into a reality in 2025. Thanks for watching. I'm Nicole, real estate broker, helping you buy, sell, build, and invest, and I'll see you in the next one.